Can everyone hear me? Jeez, everyone's like, anyone hear anything? Relax. I can already tell, like, come on, guys. Like, if you guys, like, are impatient to follow instructions, like, what makes you think you're going to be able to follow a systematic strategy when you're trading? How are you gonna be patient when you're trading? Can everybody see my screen? Okay. So, what is options trading, right? What is it? Oh, 1 second. For those who want to access the last video from the last class, you have to go to, give me a second, go to tcx.com. Right, mine's already logged in. You guys see my screen, right? Go here, tcxacademy.com. Your login is given to you, okay, through your email. Okay, you guys can see the screen, right? It says library, evolution course. You click it, okay, and you just click this one, and then this one is going to be the one from today. And you just click it, right? You click it, and then once you view it, you mark it as complete, okay? And then there is a comment section down here below, right? You know, if you have any comments on how the class went, things like that. And we're working on the access to PowerPoint, so you know, just hold off on that because we're still, you know, working on everything. This course is going to be here forever, right? This is going to be the main course that we kind of are putting out there. So you guys are like the first people to join. So that's why there's a lot of these, you know, little things that we got to keep adding on. So, you know, just bear with us. It doesn't take, you know, it's the process of getting this website itself, you know, we had to pay thousands of dollars just to have this kind of fucking just to have this kind of um interface. You know what I mean? So it's not like, you know, it's not like a bullshit course that we're gonna have. So, you know, I would appreciate it if people are a little bit more, you know, understanding if, you know, things might take a while, that kind of anyways, going back to the slide. What is options trading, right? So a stock option is essentially a contract between two parties in which the stock option buyer, the holder, purchases the right but not the obligation to sell 100 shares of an underlying stock at a predetermined price from the option seller, aka the writer, within a fixed period of time. Okay. So the two types of stock options are puts and calls. Obviously, calls, you want it to go up, puts, you want it to go down, right? So call options confers the buyer the right to buy the underlying stock, while put options give him the right to sell them, okay? A strike price is the price in which we choose to become long or long or short the stock using an option. Unlike stocks where we're forced to trade the actual current price, we can actually choose from different strikes that are above or below the actual stock price. okay, that have different values and probabilities of profit. When you're choosing these strikes, there are a few concepts to actually consider. The probability of the option expiring completely worthless, where, if you, for example, if you let it run till expiration and your call doesn't go, in the money or whatnot, it's going to expire worthless, right? So you lose all your premium basically. Okay, so all option strikes are made up of intrinsic and extrinsic value. Extrinsic is time and volatility, meaning they are external factors. Okay. The intrinsic value of an option represents the current value of the option, or in other words, how much in the money it is. Okay. For options that are out of the money or at the money, the intrinsic value is always going to be zero. This is because a buyer would never exercise an option that would result in a loss. Here's an example of intrinsic value. So intrinsic value, it's the current price subtracted by the strike price. So if the stock price is 56, right? If the stock is trading at 56 and you're choosing a strike price of 50, the intrinsic value is 6, okay? Now, what if you choose a stock price of 80 and the strike price is 70? What's the intrinsic? 10, right? So just if you refer to this example here, you can see that the intrinsic value of this example is 100, right? The stock price is at $100. If you choose an $85 strike price, okay, your intrinsic value is going to be $15. If you choose 90, it's going to be 10, 95, 5, 100, 0, and so on. As the strike price gets higher, the intrinsic value for calls decrease because you are going further out of the money. Okay. Now look at this example on the right. This is actually a good picture that I got online. So you can see I'm gonna go over time value after this, but you can see that this is the strike, right? The 50 strike. The stock price that it's trading at currently is $56. So the intrinsic value here is what? 6, right? It's 6. So the price of this, the premium of this option is 8, which is 800 essentially, right? So the stock price is 56, strike price is 50. The $6 is the intrinsic, and there is the 2 here. This 2 represents the time value. Okay, so when you add those, you get what? You get, it's not just 8, it's the premium, right? You get what you pay for, right? So this makes up that premium. If people are wondering, how do you determine how much I'm paying for this option? If I want to go buy Apple calls, why is it that Apple calls are $200 and not 300 for certain strikes, right? If you choose a Tesla call or Tesla put at a 800 at a 800 strike, why are you paying $1,600? What makes up that contract? How do you determine how much you pay for the contract, right? So this is it. Time value plus intrinsic value. Make sense? So yeah, it doesn't matter how slow you go as long as you don't stop, right? I just got this quote just to put it out there because I know some people probably are struggling with trading, and a lot of people are, having difficulties learning things, having difficulties applying things when they're trading. So, as long as you keep going, stick to the process, right? You're going to see results eventually. Time value. You guys can hear me, right? Someone said volume's dropping out. I mean, Pretty sure everybody can hear me. Time value. The time value of an option is an additional amount an investor is willing to pay over the current intrinsic value. So investors are willing to pay this because an option could increase in value before its expiration date. So this means that if an option is months away from its expiration date, we can expect a higher time value on it because there is more opportunity for the option to increase or decrease in value over the next few months, right? There's more time. If an option is expiring today, we can expect its time value to be very little or nothing because there is little or no opportunity for the option to increase or decrease in value, right? So time value equals options premium, right? How much you're paying for that option subtracted by the intrinsic value, okay? So time value is options premium subtracted by intrinsic value. Okay. So option premiums, what it is intrinsic value plus time value, just like how we looked at earlier. Why extrinsic, intrinsic, and time value matters. So this, when you know these three things, right, it's going to help you understand what it is you're paying for, right? Intrinsic represents, it essentially represents what the option could be worth, right? The time value represents the possibility of the option increasing. Extrinsic helps you figure out what can affect the option, okay? Open interest, a number that shows the amount of currently open positions of options contracts, okay? How many of you look at open interest when you're picking your option contracts? Everyone should, right? You know, you kind of, especially if you're like going to like swing something, right? Or if you're like, okay, for example, let's say you're trading freaking let's say you're trading OKTA, right? Let's say you're trading something that not a lot of people are trading currently and it doesn't have that much volume or anything, right? So you got to kind of figure out if the option that you're buying right now, is anyone willing to buy it off of you? Is anyone willing to take it off of your hands, right? Because what happens when you are trading something and you have like 10 contracts and the open interest is 2? What do you guys think? Do you guys know what you think is going to happen? You can't sell it, right? You can't sell it. You can't just call up your friend Brandon like, hey, Brandon, can you take these contracts off of me? Like, no, you can't do that. So open interest is a number that shows the amount of currently open positions of options contracts. The higher the open interest of a contract, the more open positions there are for it. Quite simply, it represents the number of options contracts in existence. Okay. How do you view open interest? If you're using Robinhood, all you got to do is click the contract, go to the settings, and you can see it there. If you're on Thinkorswim, all you have to do is click the settings within the options chain and click open interest. Okay. The liquidity of options contracts is very important to traders. Okay. Liquidity gives you an idea of how easily specific options can be bought and sold at the market price. Highly liquid ones are generally easy to buy and sell, and orders are going to be filled very quickly. Ones with low liquidity, on the other hand, just like I mentioned earlier, aren't necessarily that easy to trade. So ideally, you want to be trading ones with a high liquidity to ensure that you can enter and exit positions with relative ease. So does that kind of make sense as to when we trade options, we're usually always trading like SPY, Netflix, Facebook, Apple, Tesla, Walmart, Target, we're not trading freaking, what, ICB, we're not trading IGC. So Options contracts that have a high open interest tend to also have high liquidity. But as mentioned above, there are other factors to consider too. Those other factors are the trading volume of an option and its bid ask spread. Okay. High trading volume of an option generally indicates high liquidity. The bid and ask does as well. Only by looking at all the relevant criteria is it possible to get a reasonably accurate idea of how to determine how liquid an options contract is. Delta, theta, vega, gamma. Okay, how many of you actually, look at these things? I personally only focus on the delta and the theta. Okay, although gamma and vega are very important too. So the delta value of an option is usually expressed as a number between -1 and 1, although it can also be between -100 and 100. So this number basically tells us, right, how much the price of the option will move for every $1 the price of the underlying asset moves by. For example, a delta value of 0.20, it would mean that the option price would theoretically increase $20 for every $1 the price of the underlying security increases by, and fall $20 for every $1 the price of the underlying security falls by. So if you're choosing an Apple contract, okay, and it has a delta of 0.50 and it moves from 200 to 201, how much money did you make just off of the delta? 50, right? And if it moves down $1, you lose 50. Okay, that's how delta works, right? So the delta value is not fixed, right? It changes based on market conditions. It's going to increase as an option gets deeper into the money, and it's going to decrease as it gets further out of the money. Okay, so this is why, for example, some people who can't afford to buy Amazon options, for example, people who can't afford to buy Tesla options, right? Sometimes they'll just resort to buying a way out of the money call or a way out of the money put, right? Now, just based on looking at this definition, right? If you're choosing a Tesla contract, for example, if you're choosing a Tesla contract that's at the money right now and it costs you $1,500 and it has a delta of for example of 150, okay, and it's right at the money. It's the strike price is right where the stock price is. Now, let's say you can't afford that because your account is only at $500. So now you want to choose a way out of the money option that is literally $100 strike price away from the current price. How much do you think the delta is going to be? Do you think the delta is going to be beneficial to you when you're choosing a strike price that is that far away? That's why like a lot of people are like, sometimes they choose like an out of the money call, and they're not even expecting a big move on the stock. And then they're like, oh my gosh, like I'm not making anything. Well, yeah, maybe because your delta is like 0.000000002. Like, you're not going to make anything, right? So that's why, you don't want to go too far out unless but unless you have an idea of where the stock price might be within the expiration, right? Within that time frame. Like if Amazon is getting ready to announce something in terms of like a new feature, a new product, or if Apple is announcing a new phone, that's when buying out of the money might help, right? But then at the same time, the implied volatility might increase. So we're gonna talk about that after this too. So the extrinsic value of an options contract will diminish over time as the expiration date of that contract approaches due to the effects of time decay. And theta is basically an estimated measurement of the rate at which this happens, right? So the theta value of an option essentially shows the dollar amount at which the price of an option will fall by each day, assuming all other factors remain equal. Okay, so an option with a theta value of negative 0.01, for example, would lose 0.01 of its price each day due to time decay. So let's say your theta is 300. How much do you lose that day? How much do you lose? Let's say the theta of your option is 300. How much do you lose per day holding that contract? 300, right? This is why, like, some people, like, if you buy 0 day till expiration, right? If you're buying if let's say tomorrow, okay, let's take tomorrow as an example. Yeah, let's say you're trading tomorrow. You're gonna buy an option. You want to trade the same day, right? Let's say the theta is like 700, and the contract you buy is gonna cost you 1,000, right? So let's say you get into that trade and it doesn't move. Like, let's say you buy it right at open and the price doesn't move for the next 4 hours. Do you think your option is gonna stay at zero? Like, you're just gonna break even the whole time? Like, you're just gonna stay at zero if the stock price doesn't move? No, because your theta is literally $700, right? So that is going to kick in, right? You're gonna lose that option is gonna lose value. Okay. Vega, right? The Vega value of an option shows how much, in theory, the price will change for every percentage point the implied volatility, okay, of the underlying security increases by. On this page, we're going to explain the characteristics of Vega and how it's going to be used by all the traders, okay? So let's talk about the gamma before that. The gamma value of an option indicates how much the delta value of that option will increase for every dollar price increase in the underlying security, or for every dollar price decrease in the underlying security. For example, imagine you have a call with a delta of 0.60. Okay, if the price of the underlying security rises by $1, then the price of the call would therefore rise by 0.60. Okay, if the gamma value was 10, then the delta would increase. Oh shit. Delta would increase to 70.70. Okay. If you buy, okay, Umesh said, if I buy contract in the morning and sell market close, do I still lose money on time decay? Yeah, that's what happened to me today. I had a Tesla call that I had to open, and I ended up closing it right before the market ended, and it didn't really move much from when I bought it, but I still lost money. It literally moved like $2 from where I bought it at, right? Because what happened was, I got into it, and then I captured like $4, $5, $6, and then I thought it was gonna keep going up, so I didn't really pay attention to it, and so it went down a little bit, and I just kept it the whole day, and I kept losing value on it, especially because I chose tomorrow's expiration, because I wasn't expecting to hold that option for more than like 3 hours. Like, I just wanted to get in and get out. I just wanted to be in there and get out after like 30, 40 minutes. So, but overall in the market today, like it was, nothing was really moving, right? It's other than like Square. What else moved a little bit? Space, Roku, right? Boeing. But in terms of like the whole like tech stocks, right? Nothing was moving. So I wasn't really comfortable, I wasn't really comfortable trading anything if the main names that move the markets aren't even moving, right? Because, I mean, if I'm signaling something to my group, I don't want to signal something just because I haven't signaled anything. I don't want to be like, I don't want to just like, because I feel like sometimes I'm responsible, right? When I'm like signaling something, and I don't want to signal something just because I want to force a call, right? So basically what happened was, other than that Tesla trade, there was nothing else that I saw in the market. So I just, I was just staying put the whole time. I didn't, I was staying cash the whole time other than that. And I didn't really get into much other than the swing trades, right? So this today was actually the first day that I didn't really trade anything else. Like, it was just Tesla, and that was it. and for and that was like the first 30 minutes too. So from 6:30 all the way to 1, I didn't even do much, right? I didn't see, I literally didn't see anything that I thought was good enough for everyone else to take, right? So sometimes it is best to kind of stay put when you don't see things move the way you would like it to, right? You can't just force anything to happen, because when you start forcing things, that's when you kind of start losing focus. Why Greeks? Okay, why Greeks? Why? So the primary use of delta is to give you an idea of how much money you will make if the underlying stock moves as you expect it to, or how much you will lose if the underlying stock moves in the opposite direction. So this can then help you determine which options give you the best value for your money, okay? In terms of taking advantage of what you expect to happen. How many of you know this for a fact, have bought contracts, right? How many of you have bought contracts just to buy it, and not even, and then it wasn't until later on that you realized the contract that you bought was such a shit contract in terms of Greeks, right? That happens sometimes too, especially when, like, sometimes when you're trying to swing something, right? Like sometimes it's kind of, if you, depends on how fast you like get into it, right? Because sometimes I'm getting to a position, I kind of forget to look at the delta, right? So when you want to choose contracts, essentially, right, you want the delta to be higher than the theta, okay? Because if you have a delta of 50 and a theta of, if you have a delta of 50 and a theta of 30, okay, if the stock price moves $1 that day, how much money do you make? If the delta is 50 and the theta is 30, how much money do you make that day? 20. Okay. So what if the delta is 20 and the theta is 50 and it moves $1? Then you're down. You're like, oh my. And then that's how, when some people are like, oh my gosh, the stock price went up today. How come I'm down on my contract? Why am I down? People are like, why am I down on my contract? How am I losing money but the stock price went up? Right? That's when you kind of have to look at all these things that make up the contract, right? Just because you want to start option trading doesn't mean you can just go buy calls and puts like left and right, right? There's more to it than just buying calls and puts. Like, you know, this is the nitty gritty of options right here, okay? So ideally, if you're speculating on small movements, you want to be trading options that have low theta values so that the effect of time decay doesn't wipe out any profits that you make from those small movements. This is what I was just talking about, okay? If you're speculating on small movements, okay, what stock has small movements, for example, right? EA, Walmart, right? They don't really move much, okay? I've I've had messages from people who asked me, like, they're trading like really, really, really small moving stocks, like Ford or something, right? Like, hey, I bought a call and the price went up 20 cents, but it says I'm down $50. Why am I down 50? How long have you had it? I've had it for 2 days. How long has it moved? How much has it moved? It's moved like 30 cents. Oh, and did you check the theta and the delta? Right? If you're speculating on small movements, you want to be trading options that have low theta values so that the effect of time decay doesn't wipe out any profits that you make from those small movements. This is why an understanding of this value and what it means is so important. Okay. Christopher Galvin said, can you check the delta and the theta before buying options on TD Ameritrade? Yes, you can go on the options chain, okay? You click settings and you can choose what you want to see on there. You can choose to see the IV, you can choose to see the theta, delta, Greeks, everything, right? So given that Vega can be very useful, so I'm going to Vega now, okay? Given that Vega can be very useful in forecasting how the price of an option is likely to move, it's really worth putting in some time to understanding just what volatility and implied volatility is about. Okay. So once you have a clear idea of how the price of options is affected by implied volatility and changes in implied volatility, you're going to be much better positioned to gauge the risks involved in any possible trades you identify. And you might even find opportunities just based on the volatility of just the stocks alone, right? Just looking at the volatility, you're probably gonna be like, okay, I know that Vega's gonna do this, do that, do this, do this, just like that, right? So because I know a lot of people, like when they get into when they get into like options and they buy premium, they're like, oh my gosh, I don't know how much I can lose. Like, how much can I lose, right? Like, I know how much I can lose. I know I can lose. The most I can lose is only my premium, but how much can I lose if Apple drops $2, right? How much can I lose if Apple drops $3? Okay, so am I gonna be fine with Apple dropping $3 because now I know how much I can potentially lose, right? Maybe like it's not too much where I'm worried about a loss, right? Maybe if I know how much I can lose if Apple moves down $3, I'm more willing to let it. I'm more willing to hold it if it holds a support and a bounce, right? So when you know these Greeks, sometimes you can kind of gauge like, okay, maybe I shouldn't cut the loss here, right? I'm only going to be down about $20 if it goes down another dollar, right? And when if it does go down another dollar, there's a support level there. There's a support level there, and maybe it's going to bounce. Okay? Generally speaking, high gamma, okay? Gamma means high theta. Okay, a high gamma means that you can make potentially higher exponential profits if the stock moves significantly in the right direction. Okay, historical volatility versus implied volatility. Okay, I see Lord of the Raffles asked what is implied volatility before I even put the slide on there. Historical volatility, okay, is commonly known as statistical volatility and often referred to as SV. Okay, not the Lamborghini, but it's SV. Okay, it measures the price changes of the underlying security of options. So it is based on real and actual data. Okay, the IV of an option is determined by taking a number of factors into account. Okay, so whoever was asking what is implied volatility, here's the answer. Okay, the IV of an option is determined by taking a number of factors into account: the strike price, the price of the underlying stock, the SV, the length of time until expiration, and the current interest rate. Okay, there's also another thing called volatility crunch, volatility crush, whatever. Okay, the term volatility crunch is used to describe an occurrence where a high IV drops dramatically and quickly. Okay, when does this usually happen? Right, earnings, right? So it typically happens to stocks following a significant event that was expected, such as the release of earnings reports or important news, like in the above example, right? A volatility crunch can have a huge impact on the extrinsic value of options, and it means a sharp decline in price. That's why sometimes, like, how many of you bought the Tesla earnings? Um, what is it? A couple days ago, it shot up like $80. I ended up, opening it, and it was freaking um like negative. I was like negative 40, $50. I A shock because I blew my account trading Tesla earnings. You're not even supposed to, when you guys are trading, right? I mean, uh, I don't know how your risk managements are, and we're going to go over that as we get on with class and cover the rest of the topics. But like when it comes to earnings, it's literally a gamble. Like I don't understand why people would risk their whole account on something so uncertain. Like that's more uncertain than just trading it during the day, because you can't go based off of patterns when you're trading earnings, right? You go based off news, and you don't even know the news of it yet. So you have no edge. And when you're trading earnings, you have no edge. It's simply just It's 50-50, literally, right? So yeah, it's like gambling. Vertical spreads, okay? Let's talk about vertical spreads now. Just the call debit spread we're going to talk about, okay? Creating a vertical spread is basically very simple, okay? You can create one by buying options contracts using the buy to open order and selling contracts using the sell to open order. The contracts must be of the same type, have the same expiration date, and be based on the same underlying security, but have different strike prices. They can either be debit spreads, which incur an upfront cost, or credit spreads, which would give you an upfront. Okay. So, an example of a debit spread is you buy a call. Let's say you want to buy a call on company A. Okay. I'm sorry. I meant to put A here, but company A, right? It's currently trading at $20. Let's say you choose an expiration date, which is May 20th, strike price of $19, ask price of $2. You choose this ask, right? Then you sell another call, same expiration, same stock, same expiration, same stock. Now, this time the strike price is $22 and the bid is 70. Why do you choose? Do you guys know why you choose the 22 for when you sell it? You guys know why you choose the 22? Why you sell the 22 and you buy the 19? This is so you can protect yourself from a complete loss, right? So when you buy this, okay, this is a debit spread. So this means that your profits are basically already determined, right? You know what your max profit is. They tell you in your options. They will tell you, here's your max profit, here's your max loss, right? Debit spreads are essentially cheaper. They're very cheap. Like you can do it on Robinhood where it's way easier for you to choose, or you can do it on Thinkorswim. Okay. With debit spread, since it's very cheap, like it's cheaper, and then you can literally like if you can catch a whole rally, right? If you can catch a rally, then debit spreads are the way to go because if you have a smaller account and you catch a big move, okay, you catch a big move, you can get that max profit, right? So this is how the graph looks. I'm gonna show you real quick how you would buy it on Thinkorswim if you end up doing that. Can you guys see my my screen? No, huh? Okay, when you want to buy a vertical spread, you guys can see it now. Okay, let's say you want to buy, you want to go to, let's say you do SPY. Okay, let's choose May 15th here. Right, so what you do is essentially you just buy, okay, go to vertical, okay, you're buying the 291 call, right, and you're selling the 292. You can choose 293 if you want. Okay, that would increase the price. If you choose a 292 versus 291 and a 292, you're essentially paying 47 cents, which is $47. Let's change this to one contract. Okay, I'm gonna show the the risk profile on this if it lets me right now. Let me go on demand. Let's go to Oh, it's pre-buffering. Okay, there you go. Let's choose. Yeah, let's just say. Okay, cool. So let's say you want to choose this one on HD, February 15th. You want to buy the vertical. All right, so it's this one. They choose maybe 190. Okay, here it is. Right. So since we're choosing 10 contracts instead of one, okay, your max risk is 1840. Right here. You guys see this? Right? You guys see here. Let me make this to one so that it's easier to understand. So one, right? Your max risk is 184, right? That's the most you're gonna lose. Now, once Home Depot goes to, for example, from 184 to 190, how much do you make? 316, right? This is already predetermined. They already tell you how much you're going to make. This contract is cheaper than if you were to just buy a naked call, right? Because what you're doing is you're limiting more downside risk just in case, right? Where do you get that chart? You go to risk profile right here. Okay, so what you want to do, all of you, if you want to check this today, if you want to check this today, you go on demand, right? You want to turn on demand. This is how you can play around with like how much you can potentially make. You can just do this yourself, like play this around with yourself. You can find out, put spreads, everything butterflies. So just click on any stock that you want, right? On demand, click a date, click a time, okay? The time, click a date, boom. For example, me, Home Depot, right? Add simulated trades right here. Add simulated trades. You want to right click this, okay? You want to right click this. You want to analyze by trade vertical, okay? A vertical spread, vertical. And then you want to go to risk profile and it'll show you, okay? And you can also do probability analysis that you can kind of see like at what date is there more of a chance of your option being profitable, blah, 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 based on the probabilities. So that's how you look at it on Thinkorswim, okay? Let's go back to the presentation. So generally speaking, at what price did HD have to hit for you to collect that? Jeez. Go back now. You guys didn't see what I 185, and then once it hits 190, you hit max profit. Does that make sense? Okay. You buy it once it's you're buying it at 184.85. You're buying it essentially at 185-ish, right? That's where you're buying it. Once you buy it, if it goes up $5, you make double that. Okay? But that's all you make. That's all you make. So this is for small, like if you want to risk less on your account, okay, guys, if you don't want to pay $600 for your calls and you want to pay $200 instead, you go buy a debit spread, right? But just know that when you buy a debit spread, it's going to tell you the max profit that you're going to make. So it's going to tell you, hey, you're going to make $400 if this moves $6, and that's it. Even if it moves $10, you still make $600. That's it. That's all you make. Right? The profit is capped. Okay, it's capped. So other than when you compare that to a naked call, right? If the stock goes up $5-6, yeah, you make $600. But if it goes up $10, you make what? $1,000. If it goes up just like that, right? But then you have to pay more because the premium is going to be more expensive than you are buying if you were doing a debit spread. Does that make sense? It's cheaper and it's safe. That's what it is. It's for people who want to do this the safest way possible. You literally don't even risk anything. If you want to do this on SPY, you know how much it is. You know how much a debit spread is on SPY. It's like $30. You want to do a debit spread on AMD, it's like $20. You want to do a debit spread on EA, it's like $8, and your potential profit's like $60. But what it has to do is it has to move up a certain amount, right? You can do this with Tesla too if you want to, because what you're doing is you're kind of playing it smarter, right? It makes such a big move, but you don't want to risk that whole premium, right? So this is like literally, I've made I've made a lot off of debit spreads on Tesla, Amazon, and Google sometimes, right? They move so much, right? They move like $80, $90 a day sometimes, right? So if you can catch a debit spread, right, and you ride that for $90, if the max profit is like, let's say you spend $400 on, okay, let me give you guys an example, okay? Here you have an option of buying a debit spread for Tesla, okay? You're gonna spend $400, okay? Tesla's at 800, and if Tesla goes to 900, okay? If Tesla goes to 900, you're going to make, let's say, $2,000. Okay, you're gonna make no, not 2,000. That's too little. Let's say you're risking 400, but you can potentially make 4,000 if Tesla goes up $100. Now you're spending $400, right? And that option expires in a week. Okay. Now let's say you compare that to if you buy just one Tesla call, but it's gonna cost you about 1,300, right? But if it moves $100, you're gonna make like freaking, I don't know, you're gonna make a lot, right? So would you take the safer route of spending 400 and having your potential profit capped at around 4,000 as an example, or would you rather buy the $1,300 call and risk that as you go up? So the answer to that question is literally depending on how much is in your account, right? It depends on how much is in your account. If you have $30,000 in your account, you can go ahead and buy a Tesla call. But if you have like 3,000 and you want to trade Tesla and you have an idea of where it might go, like let's say the stock is in a range where it might break out, right? Let's say you get this scenario, right? You see Tesla, it's consolidating heavy for the past month, let's say. And let's say you're getting to that last day where you look at the daily chart on the candle, it's literally breaking past that top range. And let's say the next resistance is $100 away. And let's say you only have $2,000 in your account and you want to try to catch this move because it agrees with your risk to reward ratio, and it agrees with all the indicators that you're using. And so you really want to take this trade. Now, is a debit spread perfect for this? Perfect, right? And the risk to reward it depends. It's not the risk to reward is not it's not necessarily like it's set. It depends. It depends on what stock it is, right? It literally depends on what stock, what strike you choose, which expiration you choose. Because when you're choosing contracts, right, you have to look at the gamma, theta, vega, delta, right? That's all priced in there, right? So it depends on what contract you choose. Because some debit spreads you literally pay 50 and you can only make 70, right? Some debit spreads you can risk 20 and you can make 200. It depends on the contracts. That's why these contracts have different Greeks, and they have different types of values in them: time value, extrinsic, intrinsic, right? Because you can literally play around with this. You can, like, there's loopholes in this, right? You can literally work your way around in options and make money no matter where the market goes, right? It's not just you're not just, oh, I'll buy a call. No, it's not just you buying calls and puts. You can buy a call, sell a call. You can buy one call, sell two calls. You can do a lot of different things. It just requires time and for you to learn it, right? If people would just take the time to learn this stuff and do their research, man, everybody, if you spent more time doing research on options strategies, like actual options, than just looking at other strategies, you'd be better, you'd be good, because then you know how to cover your ass when something bad happens, right? You can't cover your ass with an RSI, right? An RSI is not going to tell you how to hedge your position. You know what I mean? A divergence is not going to tell you how to cover a potential loss, right? So I'm just telling you guys the importance of actually kind of understanding, options itself. There you go. So debit spreads, right? Generally speaking, you would only use the call debit spread option strategy if you are bullish on the underlying asset. Since it takes a significant move in the stock price for call debit spreads to be profitable, this is not a neutral or bearish strategy, right? Another reason to use the call debit spread option strategy is efficiency. Okay. Another reason to use the call debit spread option strategy is efficiency. Call debit spreads are an effective way to go long on any asset, and it only requires a fraction of the capital required to purchase the stock. Okay. Maximum. This is how you guys can see my screen, right? This is the maximum profit for a call debit spread and how you determine that. Okay, right here. Width, okay, width of strikes subtracted by the premium spent. Okay, so width of strikes minus the premium spent. Okay, how far the strikes are apart with each other when you choose, right? Maximum loss for call debit spread equals premium spent. Does a debit spread kind of make sense to everyone on how it works? You literally risk less to make a potential a capped amount, but it's best for smaller accounts. Like, let's say you have an account, like this is perfect for someone who has a Robinhood account right now. It's literally perfect for you because you can't have a cash account, you know. And you can buy debit spread for days. I bought Boeing debit spreads on Robinhood, Microsoft debit spreads, Twitter. This is like literally this week. Microsoft, Boeing, Apple, AAL. I had Beyond spreads, and that was it. But they're all debit spreads. Other terms and definitions. JB says, is this strat good for scalping? Well, let's say you buy like 30 debit spreads. If you buy 30 debit spreads, then you can literally scalp it. But at that point, then why don't you just buy like 10 contracts? You know what I mean? Nishi said, confused about expiration for debit spreads. Well, expirations are always the same. It's always the same. Yeah, you can choose next week's. You can choose the one in 2 weeks. You can choose 3 weeks. It depends, right? It depends which one. Think about it like this, okay? Choosing expirations, debit spreads, when you choose expirations, is just like choosing a normal call option. If you think the stock is going to move $5 within the week, do you want to choose this week's expiration or do you want to choose next week's expiration? If let's say it's Monday, okay? Let's say it's Monday, you want to swing something, right? let's say from Monday to Friday, you think that the stock might move about $5 from Monday to Friday and you want to swing, okay? Do you want to choose this week's expiration or next week's expiration? Next week's, right? You have to choose next week's, because what if you, like, do you really want to buy a swing on Monday and sell it on Thursday? No, right? Like, why, right? The theta is gonna eat up that contract as of Tuesday. As of Tuesday, Wednesday, your theta is